The process of learning about investment is comparable to learning to ride a bike. It may appear frightening and difficult at first, with imagined threats lurking around every corner. That is why it is critical to understand the foundations and implement techniques to reduce risks and protect oneself. With enough effort and education, one can finally remove the training wheels and begin riding properly. The course may shift along the way, and there will be good and bad days. While learning to ride a bike does not guarantee a spot in the Tour de France, it does provide the opportunity to reach destinations faster. Let's start with the basics and look at one of the most popular investing options: stocks. A stock represents a portion of a company's ownership. When you buy stock, you are purchasing a share or a part of the company, giving you a claim on its assets and future revenues. Investing in stocks provides two potential routes for profit. The first is through stock appreciation, which occurs when the value of your stock rises. If you buy a stock at a specific price and its value increases, you can sell it to another investor at a higher price and profit. Dividends are the second way to make money from stocks. Dividends are periodic payments made by some stocks. Dividends are paid by corporations to shareholders in order to share a percentage of their profits. Allow me to illustrate how stocks function with an example. Consider a hypothetical company called Bull Flag Cycling, which is known for producing high-quality bicycles. Because of the company's success and ambition to expand operations and sell bikes globally, it needs capital or funds. Bull Flag Cycling can collect funds in a variety of ways. One option is to obtain a loan, which would entail incurring significant debt. Alternatively, the corporation could decide to issue stock. Bull Flag Cycling can raise capital without incurring debt if it issues stock and goes public. Instead, the corporation sells shares of ownership and potential earnings to investors. Now, consider a typical investor who has some spare cash and is looking for investment that provides better returns than a savings account, despite the higher risks associated with investing in stocks. This investor perceives Bull Flag Cycling as a promising firm with growth potential and decides to purchase a share as an investment. So, how much is a share worth? Assume the company's goal is to raise $1 million by selling 1,000 shares of stock. Each share represents a portion of the value of Bull Flag Cycling, and with 1,000 shares available, each share represents 1,000th ownership in the firm. Each share is initially valued at $1,000 during the first public offering or IPO. Assume that the stock price remains unchanged after the initial public offering and that our investor buys a single share for $1,000 through an online stock broker. Let us now look at the possible results of his investment. If the company performs well and profits increase, its entire value is likely to improve. As a result, the stock price may rise as well. In this situation, if the stock price rises, our investor can benefit by selling his shares to another investor on the stock market. However, if the company's endeavors do not go as anticipated, its value may fall, resulting in a drop in the stock price. This result emphasizes the prospect of our investor incurring a loss if he sells the shares at the current price. When it comes to stock market investment, the basic goal is to buy equities at cheap prices and sell them at higher prices. However, it is critical to understand that stocks do not always demonstrate an upward trend. They can remain stable, fall, or endure severe price instability. As a result, stocks are often disregarded as riskier than traditionally safer investments such as bonds or certificate of deposit or CDs. Nonetheless, despite the inherent hazards, investors remain attracted to the stock market. What is the reason for this? The answer lies in the potential for higher gains that comes with the heightened risk of shares. While stocks fluctuate and include risks, they also provide the chance of large gains and profits, which entices investors to participate in the stock market activities. That's it for today. If you found this video helpful, please consider giving it a thumbs up and sharing it with others who might also benefit from the information. I love hearing your thoughts and ideas, so feel free to leave a comment below. Thank you again for your time and dedication. Take care, stay financially savvy, and I'll see you in the next video.